What does mark-to-market mean, and why should you care? This is the next in my series on the banking crisis, and I'm Professor Capko, and I'm going to help you understand simply what mark-to-market means in today's video. But first, I want to say that I believe something great is going to happen for you today. And now, back to the video. I have started a series on the current banking crisis, and if you haven't seen those, I'm linking the first one up here. Take a look at that video when you're done with this one. Today we're going to discuss what mark-to-market means. You may have not heard that term before, but you might start hearing it a lot more in the news. And I'm going to let you know what it means. But if you are someone who hears all kinds of financial terms used in the news and on social media, and I'm not quite sure what it means, give this video a thumbs up. That way I'll know that you are getting some value out of this, and I'll make some more to help you understand these terms that the professionals are throwing around to try and obscure what is really going on. Let's talk about how banks are doing accounting and how they've done it for a long time, just so you have a better understanding of it. As I've mentioned in prior videos, when you make a deposit into a bank for your bank account, of course the bank doesn't just take it and stick it in a box with your name on it and hold it back in the vault. What do they do with that money? They invest it. So the money is not there for you. It's there, you can withdraw it, but what you are doing is you are lending money to the bank. So your money that you deposited in the bank is actually a liability to the bank. And it's a liability because they owe it back to you. But you don't own it anymore. That money is being borrowed by the bank and they're investing it. They can invest it in mortgages, they can invest it in money markets, they can invest it in other kinds of things that are allowed. And one thing that they do invest it in is Treasury bills. Treasury bills are money that the government is borrowing. So they're taking the money that you're lending to them and they're lending it to the government to earn a certain fixed amount of interest. Now, when they are purchasing these treasury bills, that is an asset. That is an asset to the bank. So it seems backward to you because your deposit is a liability to them, and then they turn around and lend it out to the government, and that becomes an asset to the bank. So the bank's lending is an asset to them, and those assets are held on the books of the bank in various ways. There are things that have happened recently, however, with those assets that were purchased. Several banks, many banks, invest, as I said, in treasury bills. If you haven't noticed, the interest rates have been going up lately, and that means that the banks have invested money in the treasury bills at a low rate of interest, but since the market rates of interest have gone up, those treasury bills that the bank bought are no longer worth what they purchased them for. They are no longer worth that amount. So, for example, if they purchased $100,000 worth of treasury bills, and again, I'm using this as an example, these numbers do not necessarily line up with the change in interest rate. I'm using round numbers to make it easy to understand. The market value of those treasury bills right now are maybe only $80,000. And if you're not quite sure you understand why the value of the asset goes down when the interest rate goes up, take a look at my video up here where I talk about interest rates and bonds, because treasury bills are a type of bond. So that will give you a little bit of clarity. Now, this isn't always necessarily a problem, because if the bank holds this until the bonds mature, which may be 10 years from now, that is not a problem because they will get all of their money back and will earn all the interest that they've earned. However, that might become a problem if they have to sell the bonds early. So let's take a look at this liability. Liabilities and things such as the Treasury bills are accounted for in different ways depending on the nature of the investment and how they're held. There are three main categories, but let's talk about first historical value, of an asset. Many assets used by companies and banks and other entities are held at historical value. In other words, what they purchased it for, or it could be the contractual value, the contractual rate. So they keep it on the books for that historical value. So if they purchased it for $100,000, it would remain on the books for $100,000, regardless of what it is valued today. But as I mentioned, some of these have gone down in value because the market price is less for those treasury bills. Well, if it's the bank's holding at historical value, it will show up on their books as an asset worth, in this case, my example, $100,000. This is then what would be called an unrealized loss. Unrealized means it's not reflected in their books and it hasn't become real because they haven't sold that asset. So it's an unrealized loss, and unrealized losses can be opaque. In other words, they're not seen when you look at the bank's uh, financial statements. So the bank might look more healthy than it is. Now, there's another type of accounting called mark to market, and that's the subject of today's video, mark to market. Mark to market means that the asset is reclassified or at least revalued for what its market value is today. So that would mean that that $100,000 investment would now be shown as $80,000, and therefore it reduces the amount of assets that the entity has, and in the case we're explaining it is a bank, and that means the assets are lower, and that means it's closer to being insolvent. Insolvent would be if the assets are below the liabilities. If its liabilities are higher than the assets, the bank is in big trouble. Now, not all assets of the bank are accounted for by mark to market. There are three categories that the bank accounts for, and they are held to maturity, available for sale, and trading securities. I can go into these in more depth in another video. I don't want to make this video too long, but the held to maturity assets are those, as I mentioned, if they were going to hold on to that asset until it matures. And that works out okay in historical value because held to maturity is kept at historical value. And indeed, if you held that asset until maturity, you would get your money back. These are treasury bills, so they will indeed get it. The available for sale and the trading securities are all at mark to market. And because they are more likely to be sold in a sooner time period, they're reflected on the bank's balance sheet at a closer to market value. The problem is if the bank has to sell off some of these held to maturity assets to cover any kind of cash withdrawals. Now, they could sell them, or more likely, what they would do is they would borrow against them. And the problem being is the places that they can go to borrow against them, such as the Fed's discount window, or if they're going to borrow it from some other bank, they're going to mark to market the value of these assets. So in other words, the Fed's discount window is only going to lend the bank based upon the market value of those assets, not the historical value. So it immediately turns it from a held to maturity or at least a historical value to a mark to market. So this could cause big problems in liquidity for a bank, but there is another um, facility opened by the Fed recently, and that new facility is going to lend against the full historical value of the assets. And in exchange for that, when the Fed lends these banks that extra money or that money based upon the asset's full historical value, those banks that are borrowing that way, that those names are kept secret. So we don't know which banks are borrowing under that new facility, and we're not going to find out, at least no time soon. So now you know what mark to market means. If you hear it in the news, you will know what they're talking about. Hopefully you found some value in this. If you have, I ask that you subscribe to my channel and hit that notification bell so you don't miss a single video. Thank you.